Imagine a world where the invisible threads holding up the global economy snap in an instant, sending trillions in wealth evaporating into thin air. Not from a war or a pandemic, but from a quiet auction room in Tokyo where no one was watching closely enough. Right now, as you hit play on this video, Bitcoin is plunging toward 80,000, dragged down by a hidden force that's already wiped out billions in crypto holdings overnight. And the real catastrophe hasn't even begun, because this isn't just a dip, it's the prelude to a total unwind that could see Bitcoin halved while silver, the forgotten metal sitting in vaults, rockets past $200, leaving digital fortunes in the dust. But here's the terrifying part. If you think this is random market noise, you're wrong. It's a meticulously engineered domino effect starting from Japan's bond market that's about to expose the fragility of everything you own. And by the time the dust settles, only those who see the shift coming will escape unscathed. We're diving deep into why this is happening now. But the full picture, the one that could change how you protect your wealth forever, unfolds only if you stay until the end. Picture this. It's January 8, 2026, and the Bank of Japan has just wrapped up its latest 30-year government bond auction, an event that sounds as thrilling as watching paint dry to most people. But to the insiders pulling the strings of global finance, it's a seismic alarm blaring in the dead of night. The yields on these bonds have spiked to a staggering 3.53%, the highest in over 2 decades, and the demand weaker than anticipated, with bid-to-cover ratios dipping below expectations, signaling that investors are hesitating, pulling back at the very moment when stability is most needed. This isn't some abstract number on a screen. It's the cracking foundation of a system that's propped up the world's riskiest bets for years. Japan, with its ultra-low interest rates, has been the silent fuel for the carry trade. A strategy where savvy funds borrow cheap yen, convert it to dollars, and plow it into high-yield assets like US stocks and cryptocurrencies. Trillions have flowed this way, inflating bubbles from Wall Street to the blockchain. But now, with yields climbing, that cheap money is turning expensive overnight, forcing a mass exodus back to the yen, and the ripple effects are already hammering markets worldwide. As the auction results hit the wires this morning, the yen strengthened sharply against the dollar, jumping over 1% in a single session. A move that might seem minor until you realize it's the trigger for a global margin call. Hedge funds and institutions that borrowed billions in yen at near zero rates are now staring down higher borrowing costs. And to cover them, they're dumping assets en masse. US tech stocks, those darlings of the bull run, are feeling the heat first. Nvidia and Tesla shares dipped 2 to 3% in pre-market trading today alone, as leveraged positions unwind. But the real victim here is the crypto market, where volatility is off the charts. Bitcoin, which was hovering comfortably above $90,000 just days ago, has shed over 10% in the last 48 hours, trading perilously close to $82,000 as we speak. Why crypto? Because it's the ultimate leveraged play, amplified by the same carry trade liquidity that's now draining away like water from a punctured dam. Traders on platforms like Binance and Coinbase are reporting liquidation cascades, with over $500 million in positions wiped out yesterday. And the fear is palpable in the forums. People are asking if this is the start of the big one, the crash that finally bursts the digital asset bubble. Diving deeper into the mechanics, let's unpack what this bond auction really means for the carry trade. For over 2 decades, Japan's zero interest rate policy turned the yen into the world's go-to funding currency. Imagine a hedge fund in New York borrowing 100 billion yen at 0.1% interest, swapping it for dollars, and investing in Bitcoin when it was at $30,000 back in 2023. That bet paid off handsomely as BTC soared. But the trade's Achilles heel is currency fluctuation and rate hikes. With the yen appreciating, it's up 5% against the dollar this week alone. Those loans are suddenly more expensive to repay. And the rising Japanese yields make domestic bonds attractive again, pulling capital home. Today's auction weakness exacerbates this. The lower demand means the Bank of Japan might have to intervene more aggressively, potentially hiking rates further to combat inflation that's stubbornly hovering around 3%. Analysts from firms like Goldman Sachs are warning in fresh reports that this could unwind up to $1 trillion in carry trades globally, a figure that's not hyperbole, but based on estimates from the Bank for International Settlements. The contagion spreads fast. European banks exposed to yen funding are tightening credit, and emerging markets like Brazil and Turkey, which relied on this cheap capital, are seeing their currencies wobble. But amid this chaos, something fascinating is emerging in the data. The correlation between Bitcoin and the yen has spiked to a record 0.86 over the past week, a number that's sending shockwaves through quantitative trading desks. This means that for every twitch in the yen's value, Bitcoin is moving in near-perfect lockstep. More than ever before in its history. Why this sudden symbiosis? It's the carry trade's dark underbelly at work. Crypto, with its 24/7 markets and high leverage, up to 100x on some exchanges, has become a prime destination for carry trade profits. Funds borrow yen, buy BTC, and ride the wave. But when the yen strengthens, They sell crypto first to raise dollars for repayment. Chart after chart from TradingView and Bloomberg shows this eerie dance. As the USD-JPY pair drops, yen gaining. Bitcoin's price craters in tandem. Just yesterday, as auction news leaked, the correlation hit that 0.86 peak during Asian trading hours. Coinciding with a 4% intraday BTC drop, crypto influencers on X are buzzing about it, with threads garnering thousands of likes warning that this isn't a temporary blip, but a structural shift. If the carry unwind accelerates, Bitcoin could test $60,000 lows from 2024, erasing gains for late entrants. To understand how we got here, we need to rewind to the post-pandemic era, when central banks flooded the world with liquidity, and Japan doubled down on its quantitative easing. The Bank of Japan owned over half of the government's debt by 2025, keeping yields artificially suppressed to stimulate a stagnant economy. But inflation, fueled by global energy shocks and supply chain snarls, finally caught up. Last year's subtle rate hikes from negative territory to 0.25% were warning shots. But today's auction marks the escalation. Weak demand isn't just a one-off. It's a symptom of shifting investor sentiment. Japanese pension funds, managing trillions, are repatriating capital, selling foreign assets to buy domestic bonds, yielding over 3.5% risk-free. This great unwind isn't theoretical. Data from the Ministry of Finance shows net outflows reversing, with but $200 billion flowing back into JGBs this month alone. For crypto holders, this means the liquidity that pumped Bitcoin from $20,000 in 2022 to its all-time high of $105,000 last year is vanishing. Exchanges are reporting record withdrawal volumes, and stablecoin reserves are dipping as traders flee to cash. As we peel back the layers, the human stories behind these numbers start to emerge, painting a picture of vulnerability that's all too real. Take the case of a mid-level trader in London, who's been leveraging yen borrowings to amplify his Bitcoin positions. Stories like his are flooding Reddit's RR cryptocurrency subreddit right now, with posts about margin calls hitting at 3 a.m., wiping out life savings built on the promise of endless upside. Or consider the institutional side. Major players like BlackRock and Fidelity, with their Bitcoin ETFs holding billions, are quietly hedging against this yen risk. But retail investors, they're caught flat-footed, watching their portfolios bleed red as the correlation locks in. This isn't just about numbers. It's about dreams deferred, retirements postponed, and the stark realization that crypto's decentralization myth crumbles when tied to traditional finance's whims. And yet, as the auction's weakness reverberates, whispers of opportunity arise, not in clinging to Bitcoin, but in pivoting to something more resilient, something that thrives when fiat systems falter. Shifting our gaze to the broader implications, this carry trade unwind isn't isolated to crypto. It's a harbinger for the entire leveraged economy. U.S. Treasury yields are creeping up in sympathy, with a 10-year note touching 4.2% today. As Japanese sellers offload holdings to chase home yields, this squeezes mortgage rates, already straining American homeowners, and could tip the housing market into recession territory. Economists at JP Morgan are forecasting a 0.5% GDP drag on the U.S. if the unwind persists, with knock-on effects to employment and consumer spending. In the UK, where pension funds have similar exposures, the pound is wobbling against the yen, prompting calls for Bank of England intervention. But back to crypto, with the Bitcoin-yen correlation at 0.86, every BOJ statement becomes a potential nuke. If yields push to 4%, a scenario floated in today's analyst notes. The unwind could liquidate another $300 billion in positions, sending BTC below $70,000. The fear is real. Volatility indexes like the crypto fear and greed are plunging into extreme fear territory, reminiscent of the 2022 bear market. Now, as we approach the heart of this unfolding drama, a critical question emerges. Why is silver, of all things, positioned to outpace Bitcoin in this turmoil? At first glance, it seems counterintuitive. Silver, the industrial metal used in solar panels and electronics, versus the digital gold of the future. But dig deeper, and the logic crystallizes. Silver's price has been climbing steadily, trading at $78 per ounce today, up 2% amid the chaos, while Bitcoin stumbles. The key lies in silver's dual nature. It's both a monetary hedge against currency debasement and an industrial staple in high demand. As the carry trade unwinds, central banks like the Fed may be forced to print more dollars to absorb the selling pressure from Japanese repatriation, diluting the currency and igniting inflation. Conditions where silver historically shines. Data from the Silver Institute shows global demand hitting record highs in 2025, driven by green energy transitions, with solar alone consuming 14% more silver year over year. But here's where the narrative takes a sharper turn. The midpoint revelation that reframes everything we've discussed. What if this Bitcoin-yen lockstep isn't just a symptom of the carry unwind, but a deliberate signal from the markets that crypto's era as the ultimate store of value is cracking under pressure? For years, Bitcoin evangelists touted it as immune to traditional finance's pitfalls, a decentralized fortress against central bank meddling. Yet, this 0.86 correlation exposes the lie. Crypto is deeply entangled in the fiat web, reliant on cheap leverage from places like Japan. Fresh analyses from Coinmetrics, released this morning, show that over 40% of Bitcoin's recent liquidity came from yen-funded trades, meaning the asset's price is artificially inflated by the very system it claims to disrupt. This contradiction hits hard. Investors who fled to BTC for safety are now the most vulnerable, facing amplified losses as the unwind accelerates. And in this vacuum, silver emerges not as a relic, but as the anti-leverage powerhouse, physical, tangible, with no counterparty risk, immune to margin calls or exchange hacks, escalating the tension. Consider the industrial tailwinds propelling silver forward even as crypto reels. Japan's manufacturing giants, Toyota, Sony, Panasonic, are ramping up production with a stronger yen making imports cheaper. And silver is core to their supply chains for batteries, semiconductors, and photovoltaics. Reports from Nikkei today highlight a 20% surge in silver imports to Japan in the last quarter. As firms stockpile amid global shortages, the World Silver Survey predicts a 1 million ounce deficit this year, tightening supply just as monetary flight kicks in. Meanwhile, Bitcoin's energy-intensive mining faces headwinds from rising rates, with miners in Texas and Kazakhstan reporting higher costs that could force shutdowns if prices dip further. This asymmetry is stark. Silver's floor is supported by real-world utility, while BTC's is propped by speculation now crumbling under yen pressure. As we build toward the inevitable climax, the stakes couldn't be higher. Imagine a scenario where the Bank of Japan's next move, perhaps a surprise rate hike signaled in the auction's wake, triggers a full-blown carry panic. Projections from hedge fund models leaked on Financial X accounts estimate $500 billion in forced sales across assets. With crypto bearing the brunt, Bitcoin could plummet to 50,000, a 40% drawdown from here, erasing trillions in market cap and shaking faith in the entire ecosystem. But silver? Analysts at UBS and Citigroup are updating forecasts, eyeing $150 by mid-year on inflation fears alone, with upside to $200 if the dollar weakens further from Fed printing. This isn't wishful thinking. It's backed by historical precedents, like the 2020 liquidity injection that sent silver from $12 to $30 in months, or the 1970s stagflation era, where it quadrupled while stocks lagged. The climax arrives with brutal clarity. The Japan bond auction weakness isn't a blip. It's the death knell for the carry trade era, exposing crypto's vulnerabilities and catapulting silver into the spotlight as the true hedge for 2026, with the Bitcoin-yen correlation locked at 0.86. Every yen surge is a dagger to digital assets, but silver thrives in the debris. Its price decoupled from leverage traps, buoyed by insatiable industrial demand and monetary refugee seekers. The full truth? This shift marks the end of crypto dominance and crisis hedging. Silver's path to 200 plus isn't speculation, it's inevitability, as capital flees the virtual for the verifiable, the ephemeral for the eternal. In the aftermath, as markets digest this shockwave, you're left with a profound reflection. In a world where invisible financial ties can unravel fortunes overnight, true security lies not in code or hype, but in assets that endure beyond the algorithms. This documentary isn't just a warning, it's a map to navigating the chaos ahead. If you've made it this far, you've armed yourself with insights few possess. Knowledge that could safeguard your future in an increasingly unstable landscape. Remember, the next butterfly flap in Tokyo might be closer than you think. Stay vigilant, and perhaps consider where your wealth truly belongs. Thank you for staying with me till the end. Here on The Scope, we dig past the headlines and uncover the hidden layers history tried to bury. If this documentary made you think differently, hit subscribe. Your support tells me to keep creating deeper investigations. Share this video with someone who loves powerful untold stories, and leave your thoughts in the comments. I read everyone. A new, even stronger documentary is already on the way. So stay curious, and I'll see you again soon, right here on The Scope.